Welcome, ladies and gentlemen. This is your coach at Empowerment Assets. We break it down a few quality things today. We'll be completely covering what is options trading, so you guys will be able to understand how to trade options and how to utilize it as a tool as you guys move forward. All right, so we're gonna be rocking and roll at 2 p.m., ladies and gentlemen, 2 p.m. Eastern. We're gonna get to it. We're gonna make sure that we have high quality information to be able to deliver to the people. Make sure you guys leave comments, turn on the notification button. Make sure you, ladies and gentlemen, subscribe. Let's get it. Let's get it. Let's get it. Wow, that's a blessing. Blessing to have you. Blessing to have you. Blessing to have you this afternoon. How things going your way? How's the weather? Where you at? You ready to lock and load? You ready to learn today? It's gonna be some quality information. Drop a world emoji if you're ready to learn today. See it. Drop a world emoji if you're ready to learn. Let's get it. Let's get it. I'm ready. Yeah, let's get it. We're gonna be ready. I'm gonna give everybody time to get on. I want to get on a little bit early. Let you guys know that you guys are in great hands. We're gonna be breaking down what is options. It's gonna be a complete course on how to trade options, how to utilize options, and how to actually understand what options is. So continue to keep on flooding with the messages, ladies and gentlemen. Continue to keep on flooding with the message. Make sure you guys turn on the notification bell. Make sure you guys subscribe to the YouTube. All right, let's get it. Let's get it. Let's get it. If you guys have any questions, put it in the chat. As I go through the information, I'll be replying to you, ladies and gentlemen, via chat or via voice. Let's get it. Let's get it. Um, wow, today is a phenomenal day for me. I just been building and building, slowly but surely. I've been doing this for a while. I just want to make sure that I'm able to deliver to the people. So we're gonna get it. Make sure you, ladies and gentlemen, take full advantage of today's class. Take notes, ask questions. All right. I go by the name of Coach. If you guys know, that's what they call me. So let's rock and roll today. All right, we got a little bit less than 4 minutes, and we're gonna get to it. A little bit less than 4 minutes. All right, make sure you guys spam with some of the messages. If you guys have some messages or any questions, feel free to ask it. I'm ready. I'm ready. I'm ready. All right, we got a few minutes. I'm ready. I'm ready. I'm ready. I'm ready to get this quality information in. Thank you, ladies and gentlemen, for tuning in. I know that um, is a Sunday. I usually do class on Sunday at 2 p.m. Switch it up today. I wanted to get back to the community. As you get back to the community, ladies and gentlemen, you have to understand that everybody doesn't have the financial resources to be able to pay to get into multiple groups. So I try to make sure that I deliver something free every month or every other month to the people so the people can take full advantage of the information and utilize it. And if you are giving out quality information and people like your vibes and your information, people will eventually come back and do business with you. And that's what it's all about. It's all about giving somebody an opportunity to see what you offer, right? And if you offer anything of quality, the people will actually come back and the people will speak upon you. So everything's off a recommendation. All right. What's going on? How you doing today? How you doing today? Drop a world emoji if you're ready to learn today. Drop a world emoji if you're ready to learn today. Drop a world emoji if you're ready to learn today. Drop that world emoji. All right, let's get it. Let's get it. All right, ladies and gentlemen, we got less than 3 minutes. I just want to say I'm proud of everybody that's introduced themselves to investment. I don't care if you're options trading, futures trading, a long-term investment, or a bundle of multiple. All right, we want to just continue to keep on building up our community, which is the trading community. We want to make sure that we're able to reach old and young, new and experienced traders. We want to make sure that we all on one accord. Make sure we all on one accord. All right, we got less than 2 minutes, ladies and gentlemen. I'm gonna rock and roll. All right, less than 2 minutes. We're gonna rock and roll, ladies and gentlemen. Less than 2 minutes. All right. I'm ecstatic for today. Free class. I'm ecstatic today. I'm ready to deliver some information. I know a lot of people have a hard times with options. What is options? I'm gonna try to break it down to you guys and layman's terms so you guys can understand how to utilize it. It works for all multiple platforms. It's just a little bit tweak if you're trading on Robinhood, E-Trade, Thinkorswim, Charles Schwab, Webull. All of them is just pretty much just a little bit different interface and things like that. So we're going to get it. All right, we got less than a minute, ladies and gentlemen. We got less than a minute. We're going to rock and roll. We're going to fire on all cylinders. All right, ladies and gentlemen, we got less than 30 seconds. Less than 30 seconds. We're going to rock and roll. Thanks, you guys, for the likes, the comments. Everybody that's viewing me, ladies and gentlemen, I go by the name of Coach at Empowerment Assets. My goal is to deliver quality information to put you in position to be successful as you move forward on your trading journey. All right. Let's get it. Let's get it. Let's get it. 5, 4, 3, 2, 1. Welcome, ladies and gentlemen. This is your coach at Empowerment Assets. We'll be breaking down complete option course. All right. So this is all about options trading, ladies and gentlemen. This is going to be a master class, ladies and gentlemen. Make sure you guys take notes. Make sure you guys take notes. Ask questions inside the chat. I will reply via message or via voice. Let's get to it. Today is one of those days. All right. Option packaging course, ladies and gentlemen. This is going to be very fun, right? It's going to be very fun. It's going to be very entertaining. Make sure you, ladies and gentlemen, ask questions. Let's get to it. Now, first thing first. And I always get asked, what is options, right? What is options, ladies and gentlemen? We know that in life we have options as individuals, right, as human beings. So option is contracting an agreement between a buyer and a seller, right? So in a market, somebody is selling and somebody is buying, right? Somebody is selling and somebody is buying, right? So if you buy something, that means somebody sold something to you. If you sell something, that means somebody bought it for you. Now, it gives the seller of the option the right, but not the obligation, right? To actually, hey, I want to exercise these shares. I want to take these shares. But the key ingredient, each contract is worth 100 shares, right? So we're doing options. Each contract is worth 100 shares. So we know on both sides of options, we got to call, and we'll get into that later. But option contract is an agreement between a buyer and a seller. It's an agreement between a buyer and seller. Each contract is worth 100 shares. Take that note, put it in the chat. Each option contract is 100 shares. So if you buy 2 option contracts, you holding 200 shares. You buy 3 contracts, you're holding 300 shares. Now, you have a right, but not an obligation to actually exercise and take away the shares, but you are actually pretty much borrowing the shares to make money if it goes up and it goes down. Now, let's talk about how options are derived, right? So options is derived from something that we call a derivative, right? So derivative is any financial instrument that we can make money if it goes to the upside or to the downside. So in the market of a derivatives, we are trading stocks, bonds, commodities, currencies, interest rate, and market indices. Let's talk about these because this is very important. If we're trading a stock, we're trading an individual company, right? So an individual company. So you can trade things like Microsoft, Google, Apple, Intel, McDonald's. You could trade things like let's say Caterpillar. You could trade things like GM. You could trade things like Riot. These are individual companies, right? You could trade these individually. You can trade them to the upside. You could trade them to the downside, or you can buy them long term. So that's why it's very, very important to understand when you are trading option, you're trading something in the form of a derivative. So derivatives are financial product whose volume is based off the underlying asset. So if a individual stock goes up and you in a call, you make money. If an individual stock goes down and you in a put, you make money. And then we have bonds, right? We know that we can trade bonds to the upside or bonds to the downside, or we can trade commodities. Now, when it gets to commodities, ladies and gentlemen, it's so many commodities in the world. The number one commodity in the world is oil, right? A barrel of oil, we like to say petroleum. Now, oil can be traded, and oil is very lucrative. It's very profitable, right? We can trade platinum. We can trade gold. We can trade silver. It's so many different things. We can trade cattle. We can trade coffee beans. We can trade corn. We can trade soybeans. These are all fall under the umbrella of a commodity, right? So the world is based off of what commodities are buying or what commodities are people are selling. Now, currency, we know that we could trade Forex. We know that we can trade different forms of currency around the world. We can trade the peso. We can trade the pound. We can trade the sterling. We can trade so many different currency, but we have to be very, very vigilant, and we have to understand what is the companies and the countries are doing in a moment to be able to trade these currencies. If these currencies going to the upside or to the downside, is the American dollar strong? Is the American dollar weak? Is the pound strong or the pound is weak? Interest rate. This is another form of thing that we can trade. This is another form of a derivative. Now, market indices, we like to trade like SPX, NDX, and things like that, ladies and gentlemen. So it's very important to understand why are derivatives not talked about that much in that term. We know that we're trading stocks. But if we get back to stocks, I want to talk about this for a second. As options trader, we don't always trade individual stocks. We like to trade something that's called an ETF. So we know this is an exchange fund. It's multiple stocks under one umbrella, right? Under the same sector. So if I wanted to trade, like, let's say Southwest Airline, LUV, right? So let's say I want to trade AAL, American Airline. If I don't want to trade them individually, I can trade the ETF JETS. So I can make money to the upside or to the downside because it's a basket of companies within the same sector that I can all trade them all at once. All right. That's what a derivative is. Now, when we get to options, we understand that we're trading calls, right? So we understand that calls are bullish, right? So we say, hey, as a trader, we did our technical analysis, we did our assessment. We're looking to trade calls to the upside on an individual stock or ETF. So in a world of a call option contract, is we are bullish, right? So in the market, we are bullish, ladies and gentlemen. So a call option is a contract. It gives you a right, but not the obligation to buy a stock or an index at a specific price. The price is called a strike price. So when we are trading stocks, ladies and gentlemen, we're trading specific strike prices. And we're going to get into those details as well, right? And we're looking for expiration dates. So a call is a bullish opportunity to make money. We're looking for the stock to go to the upside or the market completely to go to the upside or a sector to go up to the upside. Now, when you're doing a call option, you're thinking up, right? So my whole thing is you want to be in a bullish what? A bullish trade. So I always try to tell people, I give you an example. If you buy a $50 call, you are saying, hey, I believe that the stock is going to go up to the upside on blah, 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 blah stock. Now, as the stock moves before expiration date, if it accelerates to the upside, you're being profitable as a trader. That's what we like to call a call options, right? So call option is giving you a right, but not the obligation to be able to make money if the ticker or the ETF goes up to the upside. Now, I try to explain to people, if it goes up, is increasing, you're making money, right? Now, it's multiple things that can actually hurt your option contract, and we're going to get into that a little bit later. Now, exercising and buying shares, most traders just sell the contracts. They don't want to exercise and take away the shares, but that's something somebody should think about as they actually advance their skills when it comes to option trading. You want to be able to acquire the shares by exercising them, and that's something that can be very lucrative as you move forward. Now, if the stock does not goes up, if you want to call, you're losing money because the stock is going down. So it's always a 50-50, right? Either you're going to win or you're going to lose in the stock market. And it's just part of the game. I think a lot of people say, hey, I'm just going to win. No, the stock market is a give and take thing. It's a give and take. Now, I try to explain to people there's multiple ways that you can trade calls. You can trade 0 DTE. These are the same day expiration contracts. So these contracts, you're looking for direction and momentum. If you get direction and momentum, you can make money pretty fast. But if you got some form of consolidation, your 0 DTEs will actually get killed on demand. Now, we're looking for expiration date. We're looking for the contracts to move pretty fast on 0 DTEs because guess what? You want to make money fast, right? 0 DTEs, you don't have time on these contracts. It's the same day expiration. Now, I try to explain to people you are trading live levels. So when you're trading 0 DTEs, you want to have the chart pulled up on multiple time frames. Me personally, nothing outside of the 15-minute time frame, 15-minute time frame on down, nothing above, right? Because I'm looking at 0 DTEs on SPY, QQQ, IWM, SPX, NDX, and things like that. I need the least amount of data and information as possible, right? I'm looking to actually trade that momentum and that direction in the moment. Now, when it comes to day trading calls, we got multiple ways we can trade. We can day trade, we can 0 DTEs. Now, day trade, as you're trading with between that daytime, you're looking to be profitable from 9:30 a.m. Eastern, and before the bell closed at 4 p.m. Right? So I have a window. I'm looking to be profitable within this window. That's what day trading is. Now, The advantage of a day trade and over zero DTE, zero DTE, if the direction and the momentum is not in your direction, your contracts is losing 10, 20, 30, 40, 50% immediately. On a day trade, you can get a move against you the first 15, 20 minutes, 30 minutes, but let's say in the next 60 minutes, 90 minutes, it comes back in your direction, you're able to be profitable. Now, on the call side, we also have something that's called swing trade. Swing trade is 1 day or longer, right? To say, you know what? I know that, hey, we got to fill 2 down. I know that we got to fill 2 up. I'm looking for this ticket to retrace. So I'm going to buy 3 days on this contract, right? So let's say it's Monday. You say, you know what? I'm looking to swing SPY into Friday. So guess what? I'm going to buy 4 days on this contract. I'm going to give it time. I'd rather have the time and not need it and need the time and not have it as a trader, right? So when it comes to calls, we got multiple ways to trade. Zero DTEs, day trade, swing trade. And one of my favorite is something that's called leaps. This LEAPS. These are leap contracts. We say, you know what? I'm looking to do a leap. 6 months, I'm looking to do 1 year, I'm looking to do 2 years out because I believe in the fundamentals of the company. I'm looking to actually see the company actually accelerate over the next 6 months, 12 months, 18 months, and I'm looking to be profitable over that given period of time, right? So leaps give you an opportunity to make you feel like that you're owning shares, but you allow it to actually accumulate over time. So leaps to me is a very profitable strategy when it comes to call. So calls, you're predicting that the market is going to go up to an uptrend. So you're doing zero DTEs, you're doing day trades, you're doing swing trades, and you're doing leaps. Now, if you're feeling bullish on the market and you want to get outside of option, you can just buy the shares and allow the shares to actually accumulate over time. That's what we like to call a long-term investor. So when we're looking at calls, we're looking at multiple ways to trade the market. You can be a scalper. You can be a day trader. You can be a swing trader. You can be all 3 of these, ladies and gentlemen, but you have to have the strategy and a mindset to actually trade the market. Now, let's talk about this for a minute. I think people get this confused. You want to slowly build up your confidence in the market. You want to slowly build it up. You don't want to rush into things as an option trader. It's going to take you time. So do not rush into it, ladies and gentlemen. So you want to believe in the business model of a company that you are trading. You want to believe in it. You don't want to just trade. I try to explain to people, no matter if you're doing calls or puts, you want to know the ins and out of this company. Why do the company move, right? Why do the company consolidate? So you want to know all of these things before you become a trader. Hey, I like Coca-Cola, but why Coca-Cola doesn't never beat earnings? I like Pepsi. Why Pepsi always be earning? So these things actually makes you a more sharper and a more better trader, right? Understanding the company and the fundamentals of the company. All right, next thing. Outside of calls, we got something that's called puts, ladies and gentlemen. This is the opposite of being bullish. We are being bearish. So put contracts works the same way as calls, but we're placing a fundamental trade, right? We say, you know, we did our assessment and we're thinking that this stock or this sector or this ETF is going to go to the downside. So we're going to make an educational judgment based off our technical analysis and fundamental information. Hey, we're going to either do a zero DTE, we're going to either do a intraday, which is day trading, or we're going to do a swing trade, or we're going to do a leap. We say, hey, we don't like the business model of this company. We're going to do a leap on this company for 1 year, 6 months, 18 months, 2 years out. And then boom, you're waiting until you get to a certain percentage level. And you say, you know what? I'm looking to cash out on this trade at 30%, 50%, 100%, and so on and so on. Now, the reason why people like to play puts a lot, because the market goes down faster than it goes up, right? A couple of weeks back, we seen SPX and SPY drop pretty much between 18 to 20 points. So that means puts paid, right? So puts is just the opposite of call. You say, you know what? I'm going to do a solid analysis and I'm going to look for the market to go to the downside and I'm going to make money while it goes to the downside. So it works the same way, puts and call. One of you being bullish and one is you being bearish. You just got to make sure that your technical analysis and your fundamental assessment is on point. If your fundamental analysis and your assessments is on point, you can actually make a quality trade. You can actually make a living in the market by just playing puts and playing calls. Now, I want to get into a few other things. I know the market is based off of puts and calls. That's the meat and potatoes. But we're going to talk about a few strategies that, as traders, that we should actually employ inside of our repertoire. Let's get to it. Now, I want to talk about this for a second. When I'm looking at the market, ladies and gentlemen, I'm looking at the market from multiple lenses. I'm looking at as a scalper. I'm a sprinter, right? I'm running a 100 meter, the 200 meter, and a 400 meter race. Now, as a day trader, I'm running a 5K. You say, you know what? I'm building up a little. I got a little time, right? I got a little time to adjust. But when you're a sprint as a scalper, the 100 to 200 to 400 meter, you don't have time to adjust. So day trader, you're a 5K runner. You have time to adjust, right? Because you have 5 kilometers, right? You got 3.10 miles. You say, you know what? I'm going to figure it out, right? I can adjust. If I have to slow down, I have to slow down, right? But when you're sprinting, you're a scalper, you don't have time to really adjust, right? Either you got the direction right, either the momentum is in your favor or not. Now, as a swing trader, we go a little bit further. As a swing trader, I'm looking to say, hey, you know what? I'm looking around a half a marathon, right? I'm looking to actually hold on to this trade because I know I'm gonna be out on this course for a long period of time as a swing trader, right? So if you're running a half marathon, you know there's 13.2 miles. So as a swing trader, you say, you know what? I got 3 months on this contract, right? I got 2 months on this contract. I got a month on this contract. I'm gonna allow this contract to play out unless it hit my stop loss. Now let's get down to business. If we're doing like leaps and long-term investment, we're running a full marathon, right? Or we're running a 50K. So as a leap investor, you know that in a full marathon is 26 miles, 50K is 31 miles. So you say, you know what, I have time. So if time is your friend, ladies and gentlemen, you want to utilize it. So I would rather have the time and need it and need the time and not have it. So when you get to these levels, all of these things start making more sense to you. You want to be able to strategize. You want to be able to strategize and strategize. So if you're scalping, you're sprinting. If you're a day trader, you're doing a 5K and so on and so on from now. You have to understand what type of trader you are. You can be multiple traders, but you have to understand, you have to master these things. You got to continue to keep on mastering. All right, next thing, let's talk about strategies, right? We know we got calls, we know we got puts, but I want to talk about a straddle. So in the stock market as a trader, you want to be able to deploy a straddle, right? You want to deploy it, right? When would you deploy a straddle? Let's talk about it. So a straddle is a neutral position. You're bullish and you're bearish, right? You're bullish and you are bearish. You say, you know what? I don't know what it's going to do for earnings report, but I want to swing a straddle, right? I'm not saying it's the best strategy to use, but it's a strategy that you can deploy, right? So you're doing a put in the call simultaneously at the money contract, same day expiration. So you say, you know what, I'm gonna do a straddle on Nike, $75 call, $75 put. And then the way you make money is off of the premium. If your premium is 200 on the calls and 200 on the put, that's $400 premium total. So you know that you need to make over $400 to be profitable on this trade, right? So let's say you lose the put completely, you get wiped out for the 200, but the call goes up to 600 and you cash out for 600. That means you're $200 profitable because you lost the 200 on the put side and you made $400 plus on the call side. So you walk away $200 profitable. So that's, to me, that's still a sweet trade. That's an awesome trade. So a straddle, you just say, you know what, I'm playing both ways. I'm playing out the money, same expiration date, same strike price. So that's what a straddle is, ladies and gentlemen. You are in a neutral position. You're bullish and you're bearish. You're looking to take full advantage of movement no matter which direction it goes. All right, now I try to explain to people it's other strategy that I like to utilize. So this is called a strap. So a strap is a little bit different from a straddle. So a strap is basically you're buying two calls and one puts. You say, you know what, I'm feeling more bullish than I'm feeling bearish. So you say, you know what, I'm going to deploy this strategy. I'm using two calls and I'm using one put simultaneously, right? And all these contracts are bought out the money. So whatever the current price is, let's say Apple is at $100, I'm gonna buy two calls, strike price out $100, and I'm gonna buy one put out $100. And it works the same way when it comes to premium. If you paid 100 here, 100 here, 100 here, that's $300 total. But you really want it to go to the upside because you're a little bit more bullish than you are bearish. So this is what we call a strap. The next one is if we are deploying a strip, you're a little bit more bearish. You two puts, you one call. So you say, you know what, I'm about two puts and one calls. I'm a little bit more bearish on this position. If we go to the downside, I'm able to make money, right? But you still are deploying a strategy or you're buying some form of protection. So you always want to buy protection in the market. As a trader, the more protection that you buy in the market, the better off you can become. All right. Now, let's talk about risk management. As traders, we need to utilize risk management. Risk management, to me, is one of the most important things as a trader and also an investor. You want to plan your trade size. This is contract size. You don't want to, hey, I'm gonna do unlimited amounts of contract. No, you want to know how many contracts you want to place before you get into a trade as an investor, right? You want to consider your wins and your losses, whatever your percentage is, 10, 20, 30%, 40%, 50%, depends on how aggressive you are. You want to consider your wins and your losses, right? You want to set stop losses, trail stop losses, and then you want to calculate your expected returns. And you can do that basically by looking at the Greeks when we get to those slides. You can look at the Greeks and say, you know what, if my delta it's $50. If we move $2, I make $100. So hey, you know what? I'm willing to take that profit off the table with a $2 move, right? So risk management is everything, and you can actually add that on with psychology. You want to be able to manage your risk, and you want to be able to manage the way you think about the market. So psychology and risk management is everything. You want to plan your contract size, consider your wins and your losses, 10, 20, and 30%, 40%, 50%. Depends on who you are as a trader and what your capital level is and what your risk level is, and also how you are feeling in the moment. All right, let's talk about option chain as an option trader. Remember, we talked about puts and calls. We talked about multiple strategies. When it comes to an option chain, ladies and gentlemen, it depends on which brokerage you're using. You always have calls to the left. You always have puts to the right. So option train works like this. You have the ticker. You have the expiration date. You have the last price. You have the bid. You have the X, right? And you also have the volume. You have the open interest. All of these things are displayed on the option chain, right? You have the Greeks and things like that because they're giving you an opportunity to see what you're investing in and how you can actually get a return on these type of things. Now, when I'm looking at the market, especially at the option chain, I'm always looking for an opportunity to be able to visualize who are buying and what they are buying, right? So Robinhood is a little bit different. You got to hit buy or you got to hit buy call, buy put, right? So if you're buying a call, you're looking to go up. If you're buying a put, you're looking to go down. Now you can hit the sell. That's when you are selling contracts, but majority of people are not selling contracts. They're not in the business to sell contracts, and collect money off of their premium. So let's talk about this. When we're looking at the option chain, we got multiple things. We got IV, we got Delta. So we're looking at Delta, right? So when we get to the point we talk about in the money, out the money, and out of the money contract, Delta is very important. So Delta is a form of a Greek, right? And we'll get to explain that open interest and volume and change. Now, I do want to talk about bid and X for a second. If you guys are buying an option contract, you have something that's called a bid. You got something that's called an X. An X, you're looking to get it out of market. You are being aggressive. You say, I want in now. All right, bid. You say, you know what? This is a limit order. I'm waiting on price to come to me. You're not guaranteed to get your bid order filled, but you're guaranteed to get your X order filled, right? If we don't have momentum, right? Boom, they get you in the trade right away. You are able to be profitable. So remember, X, you're being aggressive as a trader. I want to get in now. I want to be aggressive. I want to get in. I want to get in. All right, let's get it. Let's get it. All right, let's talk about this. When we're picking an option contract, we always pick an expiration date. Every option contract expires, no matter if it's 1 day out, 2 weeks out, 3 months out, a year out, 2 year. Every option contract is going to expire. If it's going to expire in the money, out of the money, we don't know. But every option contract is going to expire. So, and the reason that option contract expires so they can roll out new contracts. So you want to determine what time frame you want on your option contracts. I explain to people option contract is going to expire. You can buy more time, but sometimes it's not worth buying the time. So make sure that you pick an expiration that aligns up with your personality and aligns up with your capital level. Every option contract expires. All right, let's talk about premium. This is the ax, ladies and gentlemen, or this is the bid that we pay. So the premium is the amount of money that you pay for option contracts. So if your ax is $5, 5 times 100 contracts at the beginning of the slide, I told you guys write that down. That's what you're paying for the option contract. I know you guys get this question all the time. Can I lose my whole account? You can only lose what you put in the market, right? If you pay $5 for the ax times 100 contracts, your premium is $500. That's the only amount of money that you can lose unless you set a stop loss or anything like that. So your premium is what you pay for option contract. Either you're paying a bid or you're paying the ax. Let's get it. All right. I do want to talk about this. This is called moneyness, right? And I do get this question a lot. What contract should I buy, right? So moneyness is describing the amount of intrinsic volume an option contract is, right? So we're basically saying what a contract is worth. So me personally, if we buy an ITM, in the money contracts, OTM out of the money contracts, ATM at the money contract. Now, there's a big difference between the three. The most expensive one is in the money contracts, right? The second most expensive one is at the money contract, and the least expensive is OTM out of the money contract. So the way this works, ladies and gentlemen, if Apple current price is $100 and you buy at the money, you buy at the money, $100 calls, $100 puts. Now, if you're buying in the money contracts on Apple, if Apple is $100, you're buying $95, $90, 88, 86, 87. You're buying in the money, you're getting a higher what? Delta. So you're looking to make money pretty fast. Now, the most popular contract is OTM. These are out of the money contracts. So if Apple was $100, you're about a 105, 110. As the contract moves to 105, 110, you are making profit, right? Because the contract is pretty cheap. If you bought it for $3, if we move $3, $4 and your delta started increasing, let's say your delta goes from $5 to $15, we move $2 to $3, now you're making a substantial amount of profit because it's actually moving in your direction. So in the money, out of the money, or at the money contracts is a big difference when it comes to price point. And it's a big difference if you're trading zero DTEs, in the money, at the money, out of the money, because sometimes majority of out of money contracts actually expires worthless. So we want to be a little bit cautious and patient with that. So we want to make sure that we lock in. So it depends on what you're trading. So let's talk about this. If I'm trading things like Coca-Cola, if I'm trading things like Intel, if I'm trading things like, let's say, uh, let's say Pepsi, if I'm trading anything like AT&T, Verizon, I'm always trading in the money or at the money unless it's an earnings play. I'm trading out of the money, right? Because I know these tickers doesn't move that much, right? So if Coca-Cola only moves 80 cents, $1.20, why would I trade $5 out of the money? Right? I want to trade at the money or in the money because I want to take full advantage of a 30 cent, 20 cent, 40 cent, and 50 cent move on any given day, right? Now, if I'm trading things like SPX, I know people have a different strategy and a different approach. But if SPX have an ATR, average true range of $80, I can pretty much trade $40, $50 out of the money because I know on an average day, SPX can move $80. But if we only get a 30, 40 point move, my contracts can end up in the money or get close to the money, and I can be profitable as they get close to my money. So it depends on what ticker you're trading that you're going to pick in the money, at the money, or out of the money contract. So it depends on what company or ticker you're trading. That's very important. All right. Now let's talk about when you guys are picking a strike price. I know people are, I don't know what strike price to pick. Yes, you do. It's simple. If you're trading in the money, out the money, contract, if the ATR is $5, you can trade $5 out of the money. If the ATR is $3, you can trade $3 out of the money. If the ATR is $1, you can trade $1 out of the money. ATR is average true range. That's how you pick a strike price. You want to be able to pick a strike price that aligns up with the ATR. So if a company moves $30 a day, you can pick an ATR of $30 out of the money, right? Or you can split it in half. You can do 15, or you can do a quarter. That's 7.5 points, right? But the ATR is basically giving you an opportunity to pick a strike price that makes sense, right? So if you have an ATR of $30 and you're looking to do a monthly contract, you know, on any given day, you can go $30 to $50 out of a month because you have a month for this ticker to move 30, 40, and $50. So strike price is very important. You want to base that off of ATR and things like that. All right, now open interest. When you're looking at an option chain, this is very important. Open interest is a total sum of contracts that's actually haven't been exercised, contracts that haven't been sold. So open interest is very, very important. It's very, how can I say this? I want people to understand when you're looking at open interest, it makes sense to pay close attention to how many contracts have open interest for Monday, Tuesday, Wednesday, not just for this day, not for this week, not for this month, but actually a year out. If it have a lot of open interest for that given ticker and that strike price, you want to understand what's going on. You want to start doing a little bit digging. You want to see, hey, why the institution, why the banks are buying open interest, why the open interest is 300,000, why the open interest is 400,000, why the open interest is 30,000 on this given ticker on any given day. So open interest is the sum of contract that's not exercised, it's not sold. So high open interest, your antenna should go up. You should actually lock in, and you should actually intertwine them with volume. So now the difference between open interest and volume is the number of contracts that's sold in a given day. So if you see a high level of volume in a given day on SPX, SPY, QQQ, IWM, Apple, Microsoft, Meta, Nvidia, and things like that, your antenna should go up. Is it earnings report? Is it news report? Is the president of the United States is speaking? Is the Congress passing a bill? What is going on? Why the volume is actually spiking, the open interest is picking up. So now if both of those measure and they both is actually peaking on the call side, you know, it's an opportunity for you to actually trade it to the upside. If it's peaking on the downside, it's an opportunity for you to trade it to the downside. So volume and open interest is two key metrics as a trader you should actually look into. And then you can add in something that's called flow. And then flow will actually give you identity as well, right? The flow is coming in. Open interest is high, volume is high, banks are buying, institutions is buying, something is up the woodworks. You just want to buy time on those contracts. All right. Now, next thing, bid and ask. Let's talk about this. I know this is important. We covered it just shortly, but I want to go into more detail. So the bid and the ask. All right. So we know that the ask is market. You're aggressive. We know that the bid is a limit order. You say, you know what? This is the order that I'm willing to place. If it don't fill me at this order, I'm not looking to get into this contract. The ask, I want in now. I'm aggressive. I want to be able to get out of this trade. But you got something that's called in between. It's called a bid and the ask. And we got something that's called a spread. So if your ask is $100 and your bid is $85, if you get into that market, you're losing $15 per contract. So if you do 10 contracts, you lost $150. You do 2 contracts, you lost $30. So that's what we call a spread. Now, the reason why a spread would be so high, because it lacks buyers and it lacks sellers, right? It's not enough sellers, there's not enough buyers within this transaction to be able to get you in and out of this contract. And this is called liquidity. Right. So in the market, and you see a high bid and ask spread, you know, there's not enough liquidity. It's not enough liquidity. So that's a key word: liquidity, liquidity, liquidity. Now, SPY, QQQ, IWM, the liquidity is very high. So the spread is very low, $1, $2, maximum 3. So you say, you know what, I can get in this trade at market. I don't have to set a limit order, and then boom, I can actually trade my setup on those. So X, you're being aggressive. You're buying it at marks. Bid is you're buying it at a limit order. You're buying it at a limit order. You say, you know what? I want price to come to me. All right. Next, breaking even. I know you guys been into the market. I know you guys understand that you was up 100, you was down 100, and then now you're back even. Breaking even to me is a winning trade because you're still able to walk away with your capital. So breaking even to me is a winning trade. You're able to walk away with your capital, ladies and gentlemen. So breaking even to me is a phenomenal thing. All right, let's talk about intrinsic volume. Write the word, keep it, ladies and gentlemen. Intrinsic volume is the volume of a given option contract if you was to exercise or to sell it today. So the basically way this works is if you bought an option contract for 300, you made 300, your intrinsic volume is 600. If you bought it for 300, you lost 100, your intrinsic volume is 200. So intrinsic volume is just what your option contract is worth, ladies and gentlemen. It's just what your option contract is worth. Now, next thing, let's talk about intrinsic volume in a little bit more detail. Excuse me. So intrinsic volume is part of the option price that comes from time and volatility, right? So time and volatility. So the market works in multiple ways. You have time, you have volatility, right? The less time you have, the higher the volatility, the more money you make, right? So my thing is volatility is actually a great tool and volatility can be a negative tool, right? It depends if you have momentum and direction. Not far from the stock is the strike price. So in simple terms, intrinsic volume is time volume plus volatility volume, right? So it amount you are paying for the chance of the trade to move in your direction. Basically, you're looking for a favorable move before expiration date. So that's basically what it's actually telling you. Hey, intrinsic volume, this is what it's worth. We're looking for a move in our direction so we can take full advantage of the market if it goes in our direction. Now, I try to explain to people, I give them an example. If the stock price is 50 and the call strike price is 45, that means that you are in the money, right? So your intrinsic volume is $5, right? So you say, you know what? Wow, this looks like I'm winning right away, but you still need the movement in your direction to be able to be profitable. Why intrinsic volume matter? It shrinks the daily, expiration get closer, right? So you want to make money fast as possible in the stock market, especially when you're trading options, because you got multiple variations that's going against you. You want to make money pretty fast in the stock market. So intrinsic volume is what your option contract is worth if you was to exercise it or sell it. All right. So that's what it's all about. So remember, intrinsic volume is what you have. Extrinsic volume is what you're hoping for, right? So we're hoping. Let's get into that as well. All right. Time volume. When we get to the Greek stage, you want to understand that theta is a hater. I want you to write that down. Theta is a hater. Theta is a hater, right? So theta is basically one of those things that's going against you, ladies and gentlemen. We're going to talk about that in more details. All right. Volatility. Let's talk about volatility. I know a lot of people get confused. Volatility is a good and a bad thing. So volatility, ladies and gentlemen, volatility is a fluctuation of an option contract or a fluctuation of a stock going up and down. So the more volatility in your direction, you're beneficial. But if volatility goes against you, you're not beneficial. So I give you an example. If you bought a Tesla contract and the volatility was pretty much, let's say 50%, 70%, and the contract was 500, and they beat earnings and volatility increased, that contract goes from 500 to 1,000 to 2,000, 3,000 because volatility increased. As volatility increased, guess what happens, ladies and gentlemen? The price of the option contract increases. Now, the volatility can also go against you if you paid 500 for the contract and volatility was 100%, and they miss earnings report that volatility decreases. Nobody is buying it. Now, that same contract is worth $50. So volatility is your friend or your enemy, right? Now, historical volatility, we all need to understand what historical volatility is. You want to understand the history of volatility with seasonality. So if you know that Tesla is very volatile in the summer months, the spring months, you know you need to be very vigilant of Tesla, right? But if you know that Coca-Cola is less volatile in March, April, May, and June, so you know what, hey, I can make a decision because the volatility is not high. So looking at the history of volatility over any given days, 20 days, 30 days, 3 months, 2 months, 6 months, a year, you want to understand, hey, this is the history of volatility. This is when the stock moves the most, and this is when the stock moves the less, right? So now I can make an educational guess, and I can also lose fundamentals, and I can also lose technical analysis to be able to make the best decision. All right, implied volatility. Everybody need to understand is implied volatility. So if you're going to imply something is going to happen in the stock market doesn't happen, it's going to hurt you, right? So if you imply something and doesn't deliver, your contract is going to get crushed by IV, right? Your contract is going to get crushed. IV is going to crush your contracts. Delta is going to go against you. If you at the money, gamma is going to go against you. So many things go against you. Theta is going to kill your contract. So implied volatility is basically like, hey, I'm going to swing an earnings play, right? If earnings doesn't meet expectation, if the contract doesn't increase, that means implied volatility smoked them. Apple didn't beat expectation. They didn't beat EPS. They didn't beat revenue, and boom, I got smoked on option contract, right? So I'm implying something. If you're going to imply something, they have to actually meet expectations or exceed expectations. All right. Volatility index. Everybody need to understand the VIX. So when it comes to option trading, the reason I try to tell people you want to compare the market on two different levels. You want to understand what SPY, SPX, and ES is doing, and you want to understand how VIX is performing. So the VIX index was created by the Chicago Board of Exchange. It measured the 30 days volatility in the United States market, right? So it's measuring the volatility over the 30-day parameter. So this is how it works. If the VIX is up, the market is down. If the market is up, VIX is down. So they always inverse of each other. So the volatility index is measuring the volatility in the market over a 30-day perimeter. You want to make sure that you pay close attention to that. If the VIX starts spiking above 20, if the VIX starts spiking above 24, 25, 26, you know that the market is going down. But the VIX is below 12, 13, 14, 15, you know that the market is going up. So that means we're in a bull run. So volatility index is very important. You should have it handy. You should have it side by side when you're trading SPY, QQQ, SPX, IWM, NDX. You want to have all of these things next to you because every tool in the market works. You just got to utilize the tool and tweak it till it works for you, right? All right, let's talk about interest rates, how interest rate affect the stock market. We're going to talk about this because this is important. As interest rate rise, it doesn't affect same day zero DTs or same weeks, but interest rate affects contracts that's 90 days or longer. So you're affecting quarterly contracts and leaps because interest rate can affect how much money people can borrow, right? So interest rate is very important, ladies and gentlemen. Interest rate can affect the price of an option contract. People say, you know what? I would rather pay 6% on $1 million and pay 10% on $1 million, right? So that's how interest rate actually affects the stock market. Interest rate can be a positive thing or a negative thing in the market, ladies and gentlemen. Interest rate is very important, especially for quarterly contracts, leap contracts, 6-month contracts, 9-month contracts. Interest rate can actually affect those things, right? So we understand that Powell and the Federal Reserve controls the interest rate for our monetary policy in the United States of America, and it actually affects things on a global scale as well. All right. Let's talk about Greeks. Oh, I get this question all the time in the stock market and options. What is Greeks? Now, I'm going to be honest with you, ladies and gentlemen. We're not talking about a sorority, but we're talking about Greeks that actually affects your option contract. We got 5 Greeks, and I'm going to give you guys 2 more Greeks that you guys need to start studying a little bit more as well. But these are the 5 components of Greeks that you need to break down. We got Delta. We got Gamma, we got Theta, we got Vega, we got Rho. So let's talk about Delta for a second. Is the amount of option price change per $1 movement to the upside or to the downside? We got Gamma is the rate of change for Delta for every dollar move, right? So acceleration, right? When you see people say Gamma is moving fast, Delta, they twin brothers to me, right? They both work hand in hand. So you need both, especially if you're trading at the money contract. Theta, decay effects on your option contract. So theta is a hater. Anytime you get into an option contract, theta is taken away. But as scalpers, right, I'm really not too much worried about theta, right? Because I'm in and out of this position, right? Theta on a daily contract, it can affect you, but I'm not really worried about. I'm worried about theta if I'm doing 2, 3, 5-day contracts. You know what? Because I know that if I'm longer I stay in these contracts, the less probability I have to actually make profit, right? So theta is a hater. It's time decay. All right, now Vega is the amount of option price change for 1% and implied volatility. We talked about that. We're going to cover it a little bit more as the slides goes on. Now, Rho, sensitivity to interest rate. So we're going to break this down. As we move forward. Let's get to it. All right, Delta. Now, this is your bread and butter. As an option trader, if you don't know what your Delta is, you shouldn't trade, right? You should have a maximum amount of Delta that you're willing to take. Some people say I'm not willing to take anything less than $15 on a Delta. Some people say 25. Some people say 50. Whatever your Delta is, you need to stick to it, right? But every Delta can pay if you get momentum and you get direction, right? Every Delta can pay. It's $3 Delta, $5 Delta. And that's why you see people turn $5 to $500 because guess what? Delta increases because we had a momentum, we had a direction, we had a spike up in price, and then boom, now those contracts is at the money or in the money. Now the Delta's around $70, $80, $100, and now you're producing profit. $3 contracts to $100 a contract. We just did it last week, $10,000% contracts on CAP went from $10 to $900 plus a contract. So that was pretty awesome. Now, this is how Delta works. Delta is an option Greeks, right? This is how we get paid. Delta measure how much an option price will change when the stock prices change. So it's based off a dollar increment, ladies and gentlemen. So if your Delta is $100, You move $1, you make $100. If it moves 75 cents, you make $75. If it moves 50 cents, you make $50. If it moves 25 cents, you make $25, right? And then so on and so on from there. So your delta is based off a dollar moving, but you don't have to move a whole dollar to be profitable as an option trader, as long as it goes in your direction. Now, in simple terms, delta is sensitivity to price movement, right? So if prices move, delta moves, right? To the upside or to the downside, right? So delta can work against you or it can work with you. So if you're in calls and if it's going against you, it's working against you. If you're in calls and it's going with you, now you're being profitable as a trader. Now, option delta of a $50 mean every dollar that it goes up, you make $50, right? It's just that simple. And if you compound multiple contracts, 2 contracts, you make $100. 4 contracts, you make $200. 8 contracts, you make $400. So delta can be your friend or delta can be your enemy, right? So delta is very important. So delta volume mean who uses it, right? So a lot of people, they like to use 0 to 10, 0 to 30. So people say, you know what? I like a $10 delta. I like a $30 delta, right? So explain to people, it depends. If you're using cheaper contracts, out of the money contracts, your delta is going to be less, right? It's going to be 5, it's going to be 15, it's going to be 10, it's going to be 20, sometimes 30. Now, if you start trading at the money, right, your delta is going to be a little bit higher. So let's talk about scalping momentum trades, right? So I want you guys to look at this and study this, back test it, look at the delta. So if I'm swinging out of the money contracts, especially if I'm looking to be a trader that's, hey, you know, I'm not looking to put a lot of money into trade. I'm looking for a delta from 10 to 30. Now, as a scalper, I'm looking for a $40 to a $60 delta, right? If I'm looking to get in out of a trade on SPY, I'm looking for a decent delta, because if I do get a dollar move on SPY, I do 10 contract and my delta is $50. If we move $1, I make $50 times 5 contracts, 10 contracts, 20 contracts, 100 contracts, and so on. Now, any money contract, delta moves a little bit slower, right? Delta moves a little bit slower because you have a higher delta. It moves a little bit slower, right? But it's accuracy. That's what you're looking for. If you're trading in the money contracts, you're looking for accuracy. So that means you've been practicing, you've been practicing, you've been practicing. Now, low delta, cheaper, but need big moves, right? So I try to explain to people, if your delta is low, $5, $10, $15, you need a bigger mover to be profitable, right? But if you have a high delta, it's more expensive, it's more reliable. You don't need a bigger move to make profit, right? So the higher the delta, less movement. The lower the delta, the higher movement that you need to be more profitable, right? So that's why people say, you know what, I want to buy more contracts. So delta equals confidence, right? If your delta is 10, 15, maybe you feel a little bit more confident. If your delta is 80, you don't have to feel confident. You say, you know what, if it moves small, I make money, right? So delta equals confidence. Delta also shows probability, right? Probability. I know a lot of people don't talk about this. Delta can also read as a probability that your strike was finishing the money, right? So I want you guys to write this down. If your delta is $50, you have a 50% chance of this contract ending up in the money. If your delta is $80, you got an 80% chance. If your delta is $10, you got a 10% chance of the contract ending up in the money. That's just something that you guys can take with you and you can utilize it. Now, I give an example. If your delta is roughly $30, that's 30% chance that this contract can be profitable. If your delta is 70, you got a 70% chance. So the higher delta, the higher win probability. So you want to be able to make sure that your delta is high enough that you feel real comfortable, right? We understand that they call us dumb money in the market, but sometimes dumb money be smart money, because guess what? We're making decisions based off of our capital level and our experience level, so we still can make money. Now, I do want to leave you guys with this when it comes to the coach. They call me coach, but my name is Cardave. Real world use. When you're scalping 0 DTs, we don't want the contracts to slow down, right? We don't want the contracts to slow down. We want momentum to continue to keep on increasing, right? That's what we're talking about. Now, we choose 0 to 35, 55 delta for balance, or we do $60 to $75 delta for precise breakouts, right? Or we can use 10 to 20 delta. This is low lottos, right? So when you're trading lottos on SPX, $10 to $20 delta, that works. But if you want to be a little bit more precise, $60 to $70 delta works out for you. All right, let's get it. Now, the next Greek, this is theta, right? So theta is a hater, ladies and gentlemen. Make sure you guys write that down. Theta is not your friend. So theta is time decay, right? So the more time you are in these contracts, theta is going against you, right? So you got metrics that's going against you. So theta measures how much a volume of an option contract lose each day as it get closer to expiration date. So you want to be able to be in these contracts. You want to be profitable, right? But buying time, right? Write this down. 2 things that keep theta at bay: time and taking profit. 2 things that keep theta at bay: time and taking profit. The more time that you have on your contract, theta doesn't matter to you, right? And the faster you take your profit and the more you are profitable, theta doesn't matter to you. So those are two things that keep theta at bay. So theta is time decay. Time decay. So option loses volume every day. We know that, right? So we've been option traders for a while, or we becoming new to option trader. We understand that, hey, why these contracts is going against me? Why I'm losing money and the stock is going up? Because you have theta. If you have multiple contracts, is actually chewing away at your premium, right? All right, let's get to it. The less time left, the faster the option volume melt, right? So you understand that, hey, if you got 1 day, you got 10 contracts, and if you're losing money in your theta, these contracts is getting chewed up because it's not making any movement, it's consolidating. And once the stock consolidates, that's the worst thing as a trader, unless we're using like iron condors and things like that. Now, I'm going to give you guys an understanding. This is why zero DT contracts die faster, right? Because you have less time. You don't have any time. You got zero DTEs. If it doesn't go right away, it doesn't spike in a 30, 90 seconds, and a maximum of 3 minutes, 5 minutes, these contracts is pretty much going to be what? Over with. Now, example, an option have a theta of 0.10. This means that every day the contract loses 0.10 volume, right? From passing by. So if you got 10 contracts, you know that you're losing $1. You know, if you got 20 contracts, you're using $2 and so on and so on. So my thing is the time is one of the tools that you can use in taking profit. Now, theta, even if the stock stays still, traders types, right? You benefit, right? So these are the traders that benefit from theta, the people that sell you the contracts, right? So the sellers that sell you the contract and you're the buyer, they benefit from theta because they understand that, hey, you don't want to be in this contract too long. And if you lose right away, they get to keep your premium, right? They are making money on you because you're making what? Invalid decisions, right? So you want to make valid decision when it comes to zero DTEs, or you don't want to trade them at all, right? And you want to buy more time. So sellers of the option, they take profit from the decay. Buyers of the option, they must beat the timing with momentum, right? So you want to be able to get a zero DTE. You want to make sure that the momentum is going in your direction. As the momentum going in your direction, you are able to be profitable as a trader. All right, so those are things. Now, especially remember, especially when price is not going in your direction, right? Especially when price is not going in your direction, right? Theta don't wait on nobody, ladies and gentlemen. Theta doesn't wait on nobody. If price ain't moving, the contracts is dying, ladies and gentlemen. If price is not moving, the contracts is dying, right? If price is not moving, the contracts is down. So you want to pay close attention to that. Practical trading rules. I want you guys to understand when buying option contracts, only buy when momentum is already showing, right? Don't hope, right? Once momentum is spiking up on SPX, SPY, QQQ, don't get into the hoping phase, right? You want to be able to understand, hey, this momentum is going, I want to ride the momentum and I want to sell into momentum as well, right? So I want to hit my price targets, my percentages and all that. And you want to also avoid buying through sideways, like we like to call this indecision. We like to call this chop. We like to call this consolidation. Don't hold contracts overnight. If you're actually looking to make profit, if you don't have time on those contracts. Now, if you got a month, 3 months, 2 months, 2 weeks, 3 weeks, you can do so. But if you are profitable, ladies and gentlemen, the best thing as a trader that you can do is not hold contracts overnight, because you cannot fathom what can happen overnight, right? I've seen many times that the stock goes up 20 points after the bell. Pre-market, the stock is down 5 points. A complete reversal, right? So you want to control what you control when the market is open. If you're going to swing, make sure that you swing it, you aren't swinging things that you're willing to lose, right? So let's get to it. Now, I try to explain to people as well, when buying an option contract, you want to avoid buying during sideways, like I said earlier. But when you're scalping zero DTE, if the trade doesn't go in your direction in a 30 to 90 seconds and maximum 3 minutes, you want to be able to start thinking about things, right? You know what? Is this trade for me, right? I know SPX can move erratically. SPX can actually move pretty fast. You want to make sure that you take full advantage, right? So make sure that you guys are making solid decision when it comes to actually trading. All right, theta, Vega, right? Vega measures how sensitive the option is change in volatility, right? So we know the implied volatility, it can be our friend, or implied volatility can be our enemy, right? So implied volatility increases, low Vega contract loses volume during IV crush, right? So IV crush after earnings, I try to explain to people, if you're not willing to lose any money, don't swing in the earnings, because IV is going to kill your contract. This is called IV crush, and this is Vega, right? This is why people try to avoid buying option contracts, right? And then major things can happen after earnings. Earnings can miss, earnings can meet expectation, and major news events can happen over the weekend. Major news event after each day. Buying quality for earnings, don't let IV crush kill your profit. Basically what that is. You don't want to buy anything and swing into earnings, right? Because it's not a guarantee, right? And in this world of the market, when you're swinging earnings is a what if, right? Your technical analysis will be very good. Your assessment on fundamentals can be very great, and the company still can go left. So you want to make sure that you make an educational decision. If it's valid for you, it's valid. If it's invalid, don't trade it. All right. Next thing is row. This to me is one of my favorite. Is overlooked. Um, what is row and option trade? I try to tell people this is interest rate, right? So when Powell speaks and the Federal Reserve and the banks makes a decision, if they're going to raise interest rate, lowers interest rates to keep it the same, it's going to affect our option contracts. It's going to affect our ability and our buying power. Now, this is how it works. It's sensitive to interest rate. So if interest rate is raised, less people are borrowing money. If interest rate is lower, more people are buying more. So you want to make sure that the interest rate on the days that we have news, you want to make sure that you're not in a heavy position, right? So these are days that you don't want to be heavy because we pretty much see a lot of chop, right? So if you guys trade in the strat, you want to go back and back test when interest rates are reported. Do we create twos? Do we create threes? Do we create inside days? So you want to make sure. Now, this is how it works. It tells you how options react when Federal Reserve raises or lower rates. We understand this every Fed day. We pretty much been getting the same movement, right? We're taking out the highs, we're taking out the low, we're pretty much creating 3 bars. So if a call option have a row of 0.25 and interest rate goes about 1%, the option volume increased by 0.5, right? This is just how it works. And this is why I say people want to pay close attention to what's really going on around now. And it works the same thing for put. If the put row is 0.25, the rate goes up by 1%. That means the volume decreases by 0.5%. So you want to make sure that if interest rate is in your favor or if rate is going against you, you want to understand how much is it going against you, right? Why is row usually get ignored? I don't know. People say they get ignored. Me personally, I pay close attention. For day traders and scalper, row doesn't matter. But if I'm in like 3-month contracts, I'm in a leap contract, it makes more sense to me because it's going to affect my option contracts down the line. But if I'm scalping and I'm day trading, row doesn't make sense. But if I'm in leaps 3-month contract, it makes more sense to me. So row is most important for leaps, long-term option, and portfolio heads and institutional positioning. So that's why row is very important, but not for us if we are day trading, not for us if we are looking to scalp and things like that. All right, gamma, let's go. To me, gamma is very important. So gamma measure how fails delta changes for the stock price movement, right? So think of it like this: delta is speed and gamma is acceleration, right? So we want to make sure the contracts is going in our direction. And if gamma accelerate, we get paid, ladies and gentlemen. I know you guys been into contract and you're like, whoa, is increasing because guess what? We got acceleration from gamma, and then we got delta is increasing as well. So we got 2 variables that's going in our direction, right? When price starts to trend strong, gamma makes the option gain volume very faster, right? We want to make sure that we pay close attention to what our gamma is. That's acceleration. Is actually lighting a torch on a delta, and we accelerate making money. So this is how it works. If you got a delta of 40 and a gamma of 10, as we start moving, guess what? Now we got a new delta of 50, right? And then we continue to keep on adding on and add on and add on. So that's how we get the acceleration in these contracts. That's how we make money. We want to make money off multiple variables in the stock market, and the Greeks are the variables we need to pay close attention to, right? Price is actually moving, right? And the next move, price makes the contract move even faster. So once you guys see like SPX, I see like SPY, QQQ, and we see that movement on Apple, Microsoft, NVIDIA, and things like that. That's delta and gamma. That's gamma accelerating the delta, and we're making money. So that's why it's very important. Why gamma matters? Let's break it down. Gamma impact meaning, so in chop and sideways market is low gamma, right? So contracts feel slow and weak movement when we don't have movement in the market, but when we have a tremendous trend to the upside or to the downside, gamma accelerates our contracts. No matter if we're in a put or the call side, we want to be able to look for a high gamma, right? That's one candle, huge movement or instant loss, right? We want to be able to understand, hey, if we're trading at the money contract, these at the money contracts can benefit us from, guess what? Acceleration. So we're looking for movement in our direction. We take advantage of. Why gamma shows up the most? It shows up on SPX, SPY, IWM, 0 DTEs, and we're scalping. Power are very, very important, right? So we like the trend between 2 o'clock and 3:45 p.m. We're looking for a breakout of key levels of pre-market highs, pre-market lows, and we're looking for momentum continuation on a daily time frame. This is very important, right? So we want to take full advantage. Gamma is what makes the contract move faster once the price commits. Once price commit, we take full advantage of it. All right, so if price is trending, gamma works for you. If price is chopping, gamma works against you. So once again, I'm going to repeat this. If price is trending, gamma works for you. If price is chopped, gamma works against you because delta keep on resetting. So we want to pay close attention to that so we can take advantage of it. So if price is trending, gamma is your friend. All right, let's talk about charm. I know people look past these and say, oh, we don't want to use these, but we're just going to go over them slightly. All right, charm, aka delta decay over time. So charm measures how delta changes as time passes, even if price doesn't move, right? Read that again. Charm measures how delta changes as time passes, even if price doesn't move. Charm is why your contract fades during the chop. So it fades during the chop. So this is something that you guys want to break down. You guys want to understand. This is why your contracts melt when price is going sideways. So we see consolidation. Charm is the reason why your contracts is actually decaying, right? These are the reason why your contracts is not moving, right? Now it holds through the consolidation. It kills your premium, right? So you waiting on it. Waiting is too expensive. You're waiting on explosion, but your contract is losing volume. You're losing premium every second, every minute. Charm is strongest and zero DTEs and same week options, right? Got that? It's very strong, right? So it punishes hesitation and chop. So if you're hesitant when you get into an option contract, especially on SPX, and you see momentum and you try to jump in on a pullback, you're going to get chopped, right? So you want to ride momentum and you want to take profit into momentum. You don't want to wait for the move to happen and then you jump into the contracts and you got to deal with chop. You got to deal with sideways action. You don't want to deal with that. Now, coach, memory line. If price ain't moving, your data is dying, right? So I want you guys to understand if price is not moving, your delta is dying. So you need price to move, right? If you're in puts, you need price to go to the downside. If you're in calls, you need price to go to the upside, right? So that's one thing you guys should look into. It's very beneficial to you as a trader. All right, now, Vena, this is important. Vena delta change when volatility change. We understand that volatility changes. We want to take full advantage of volatility. So this is why it's very impactful and very important as an option trader to understand everything that can go against you and everything that can go with you, right? So Venus shows how delta change when applied volatility rises or falls, right? So this is a Greek that controls IV, right? So if IV is increasing or IV is decreasing, Venus is one of those things that control it. This is why buying before earnings is a trap. A lot of people, we understand that, hey, if you're buying before earnings, if you know it's a trap, you can trade it. But if you don't know it's a trap, you shouldn't trade it, right? So you need to understand that buying before earnings, it can be a trap because IV can kill your contracts in the form of Vena, right? So news pump fake, hype candle, and it punish chasers, right? So people say, oh, you know, they're going to beat expectation. You get into it, you put $10,000 on the trade, and then boom, you get smoked, right? Volatility changes, Vena changes, and now you're getting killed on your contracts. Now, I try to tell people this, the contract still loses money, right? If it doesn't go in your direction. So if IV drops while price is going in your direction, you're still not going to make money because guess what? Nobody is buying the contracts, right? You want people to buy a contract because you want IV to actually increases, right? You want to make sure that you take full advantage of that. Now, coach's memory. Price can be right, but timing can be wrong. Price is right, but timing can be wrong. You can have the right price, but timing can be wrong, right? Right price, timing can be wrong because guess what? You might got in a little bit early. You might got in a little bit late, but your price was right, but timing was wrong, right? So then it decide what payout is going to do. This is why I say, why does it matter, right? Let's talk about the Greek show, right? Greek is going to put you in position to understand which Greek are we paying close attention. We're paying close attention to all of the Greeks because as traders, we know that role is not important as zero DTE traders, intraday traders, right? But we know as we get further along, 3 months, 6 months, 9 months, and leap contracts, role pay attention. We're paying close attention to what? Gamma. We're paying close attention to delta, and we're paying close attention to theta. These are all things that we need to pay close attention to as a trader. Let's get to it. IV crush. Remember, ladies and gentlemen, IV is your friend or your enemy. Pay close attention to it. Take full advantage of that. All right. The two most important Greeks to me, delta, number one. This is how I get paid as an option trader. This is how I get paid as an option trader. Now, the further you in the money, the higher your delta. I'm gonna give you guys an example, right? So let's say you want to go on vacation. You say, you know, coach, I got $1,000. I want to make a contract that makes more sense to me. So I say, hey, we can buy in the money contract on Microsoft. We can buy the $20 strike prices all the way in the money. Our delta is 100. Our ax is 870. Our bid is 860. So we want to purchase this contract for 870. We're losing $10 automatically getting into this trade, right? But guess what? If the current price, last price is 28.60 and we increase to 38.60, that's a $10 move. So $10 times our delta, which is 100, we make $1,000 on the contract, right? And then boom, we sell, right? We sell, boom, we lose another $10 because we had a $10 spread. So I still walk over 1850, right? So my intrinsic volume is $1,850. So I made a hell of an investment. I made over 100% return, right? 100% return. But now, if I look at the option chain, I want to be able to invest or buy the best contract, the best bang for my buck. I would actually buy the 2750 option contract. The delta is $80. option contract is 144, right? So I can get 6 contracts, right? 6 contracts, I can get 6 whole contracts on this. And I say, you know what? I think this is more profitable for me as a trader. Now, why would this be more profitable for me as a trader? Because the math makes sense. So 144 times 6 is $864. That's what I pay for 6 contracts. And then we get the same move. We get a $10 move times my delta of $80. 80 times 10, I make 800 per contract times 6. I make $4,800 on that same investment, or a little bit less. So my thing is, sometimes it's not best about all the way in the money. It's about what makes more sense, right? So I would rather buy more contracts at 144 than buy one contract at 870. So I'll walk away with $4,800 profitable on this trade, and I'm still able to keep my premium. So this is why it makes more sense. So delta is very important as an option trader. And then also we got theta. Theta is a hater. So remember I told you, the more your money, theta is less. The more you get out of money, the theta is more. The more time you have on your contracts, theta doesn't really even matter. So 2 things to keep theta at bay: taking profit and having time. All right. Profitability. As a trader, ladies and gentlemen, in order for you to be profitable, you have to manage your emotions. You have to manage your risk, and you have to control your greed. So to be profitable, ladies and gentlemen, you have to take profit. You got to rinse and repeat, and you have to control your greed. You have to understand what you are doing, and you have to trade less so you can be more profitable. The more you trade, the higher the risk you have of losing, right? The less you trade, the higher probability the setup is, the higher probability you have to walk away being a profitable trader. All right. So profitability is everything. All right. The most important thing about option to me, ladies and gentlemen, is understanding the company and the movement, right? Understanding the company. All right. You need to understand what you are investing in. You need to understand the movement of the company. Do the company move based off of seasonality? Do the company moves before earnings? Do the company moves after earnings, right? Do the company move when it's a shakeup? You need to understand what these companies are doing before you invest in them. All right. Let's talk about this. I think we get a lot of questions on it. The process takes time. I think a lot of people fail to realize the process takes time. The process is going to take time, and you have time on your side. The more time you buy an option contract, don't look to be the best right away. Just take your time, build up a skill set. It might take you 3 months, 6 months, a year, 2 years, 3 years, 5 years. Long as you are building on that time frame and you're being profitable, long as you're respecting the process, long as you are taking profit off the table, long as you're not being greedy, long as you're not saying, you know what, I'm giving up. Just take your time. Process takes time. All right, let's talk about this. Zero DTEs, ladies and gentlemen. If you guys don't have same day zero DTE, contract expires at 4:15 p.m. So pay close attention to IWM, SPX, let's say QQQ, DIA, and things like that. But I do want to talk about something for a second. I get this question all the time. Hey, coach, what platform you like to trade on the most? I try to explain to people I like to trade on E-Trade. I like E-Trade a lot. And I try to explain to people, E-Trade to me is one of those things that you can take advantage of. So let's say on E-Trade, E-Trade is very, very important, right? So E-Trade, this is how the interface look. You can buy, you can sell, you can do all of these things on E-Trade. So you have account, pay transfer, trade in, market data, plan it. Now, let's say we want to look at, let's say SPY, SPY. All right, and we're going to look at the option chain, and we're going to see what it calls and it puts, what it allows, what's the open interest, and what is the volume. Now, personally, you come to the interface, you can see that on Friday, SPY, we had a $2.06 growth. After hour, we dropped 10 cents. We'll see how it opens up today before futures open. Now, you got Snapchat, chart, news. We want to look at options because we are option traders, right? Now, you see that we got an option chain. We got calls to the left, puts to the right. We got expiration date, right? We have strikes. Let's say we want to extend the strikes out to 11, right? So they're giving us 11 different strikes on the call side, 11 different strikes on the put side. Let's work it out. Now, man, we talked about X is the market price. Bid is what you're doing for limited, right? And this is the last price. Strike price 670 is in the money, B, right? Because the current price is 681.89. All right, boom. You understand that, hey, we got details we want to look at. Open interest, 1,020 contract. Volume is 2,000 contract. Now, but if we go down to the 682 contracts, it's pretty much almost at the money. The ax is 235. The bid is 223, so it's a $2 spread. But the volume is 60,000 contracts that were sold back and forth. It was 60,000 contracts sold back and forth. Open interest 2,873 contracts. Now, if we go down to 683, ax is 171, Bid is 168, $3 spread, but the volume is 78,460 contracts that was sold back and forth on Friday, and then 7,885 contracts were swung into tomorrow, right? So we want to understand that, hey, while they're swinging these contracts, we're going to see if they're going to be profitable when the market open. Now, the 585, these are out of the money contract. They're a little less expensive. They're $87 for the axe, 85 for the bid. 101,000 contracts was traded back and forth on Friday. 101,000 contract. Open interest is 14,423 contracts, ladies and gentlemen. Those are the contracts that's still on the ledger. So now let's say we want to look at the details. All right. So we'll pull up the details of this contract and we'll look at the contract piece, pay close attention, and lock in. Here we go. Now, when I'm looking at this contract, we open at $2.72. That's what we open at. Previous close of 183. So anybody that swung that overnight, they pretty much almost made they made $89 per contract, right? Now, volume once again, 101,000, open is 14,000. We got time premium 0.86. Now we got a range. Today low was $66, and today high was the opening 272. So we pretty much went to a low of $66. We closed the day pretty much around like $86. So that's still a $20 profit per contract as traders that bought out the low. Now, it expires tomorrow, and then expiration style is American, right? We got European option contracts, and we have American contracts. Now, when I'm looking at these option contracts, this is pretty much looking at the volume over the day, looking at the price as it increases. You can actually pretty much get an understanding that over a period of time, these contracts has been going up, and the price of SPY has been going up, and up. So you have an opportunity to look at this market, strategize, study this market, look at the delta, look at the volatility, look at all these things, right? Because you can look at these and you can actually approach the market a little bit different, right? Expiration day, we got 1 day. Volatility is 14%. That's pretty not high at all. So you say, you know what? I'm looking to trade this, right? And as I'm looking to trade this, I can be profitable as a trader, right? So you want to pay close attention to what's going on in front of you. And these are the things that you need to do as an option trader. You want to be able to look at the market. You want to be able to strategize with the market. You want to be able to understand this. All right. Now, once again, let's go back up and let's look at Amazon, right? Because Amazon was one of those trades. Earnings happened. As a group, we was able to trade Amazon. We want to be Amazon went up $21.36. It was a little bit higher than that. And we want to look at the option price for the 240s. For this week expiration, will pretty much give us the 7th of November. We want to look at the 240s, right? We want to be able to say, hey, wow, what happened with the 240s? All right. We want to click on the details, right? We want to say, wow, it opened up at $12.35. It previously closed at $3.20. So we pretty much got 3, 6, 9, 12. We pretty much got almost a 400% trade, right? If you swung that into earnings, you got a 400% trade. Now, the volume was 15,000. The open interest was 11,000. And then if you come down and you look at the side, the range of this contract from $700 to $1,295. That was the range, right? So we pretty much, the contracts pretty much did solid, right? Pretty much did a solid. We previously closed. Anybody that swung these option contract was able to be profitable. So this is how you like look at an option chain, see if it's actually beneficial to you, see if you want to trade it. All right, something else that I want to look at, right? And I get these questions all the time. SPX. We got tremendous people online that's doing a tremendous job on SPX, teaching SPX, making a decent bag off of SPX is life changing. But I want you guys to understand how SPX move. It moves erratic, right? It's pretty fast. You got to understand what you are doing with SPX. So let's look at this. Now, as I explained to the team, November the 5th, we took, let's open the option chain up. We're going to do all. We're going to look at some strike prices, right? So we current price, we closed at 68.40, right? 68.40. We're going to look at the 7,000 strike prices for the 5th, right? 7,000 strike price, right? 7,000 strike price, current price was 45, and we had a bid in the axe. It was a spread. We got open interest. We're going to look at the details, and I'm going to show you guys how many contracts was being swung and how many contracts was bought and sold. All right. Now, we opened up at 219. We previously closed at 145, so that means we made profit when the bill opened. Open interest is 5,000 contract. Volume is 3,400. That's just for the specific contract. Take it out to Wednesday. Now, as acceleration, these contracts are actually increasing volume, right? So SPX, pretty much I try to explain to people this is how it moves, and this is your opportunity to take full advantage. Now, I'm going to give you guys a little bit closer strike price. If we start looking at SPX, I'm going to give you guys a little closer strike price. Now, let's say SPX, $30 out of the money. And let's say you want to swing these contracts to Monday. Let's say you'll be looking at, let's say, strike price, let's say 68.70, right? So let's say we look at 68.70, 68.70, 68.60. All right, 6860 contracts. We're gonna look at them. We're gonna analyze. We're gonna see the low and we're gonna see the high of Friday. And I want to let you guys know you had an opportunity to trade this. So when I'm looking at this, right, this is how it works, right? This is a trajectory of everything. We got the bid, we got the ask, we got the date, we got the limit price. Remember, I told you we could do limit, we can do market. Now, let's say you don't want to pay $12.50, you want to pay $1,100. You take it out, you put the 1,100 in, you're not guaranteed to get that order filled. But if you want to do market, you change it to market. Now, once you get into a trade, you can do a trail stop loss. You can do volume. If the contract is 1,200 and you're willing to lose 50%, you can say, hey, trail stop loss $600, right? But if you go up to $1,900, it's going to follow that strike price. So looking at these things actually makes me feel real comfortable as a trader. Understand that these brokerage platform are giving me the tools. I just need to manage these tools and continue to keep on practicing at these tools so these tools can benefit me. All right. So let's go back, ladies and gentlemen. We cover options today. If you guys have any questions in the chat, feel free to ask these questions. This is just E-Trade, one of my favorite. You guys can use Robinhood. You can guys use all these things. So I thank you, ladies and gentlemen, for tuning in today. If you guys looking to reach me, Empowerment Assets on all platforms, ladies and gentlemen, we're going to rock and roll. We're going to continue to keep on building. If you guys looking to make some money this week, just lock in, just be patient. Thank you guys for tuning in the live screen, and I'm out. Peace.